It was another very volatile day in the stock market today, with the S&P 500 falling 1.16% and closing at 3281.06. Thank you for watching this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. The Simple Market Signals proprietary model helps financial advisors, money managers, and individual investors understand the trend direction and the current level of risk in the stock market, allowing you to make better, more informed asset allocation, investment, risk management, and trading decisions, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Monday, September 21st, 2020, and for this analysis we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. The first chart that we're looking at is a 2-day, 2-minute chart of the S&P 500. And as we can see here, on Monday, the 21st, we gapped down at the open and traded down to as low as 32.30 intraday before rallying back at the end of the day and closing about where we opened up. And, you know, guys, so it was good news that we rallied back at the end of the day, but I'll show you here on the next chart that I'd be surprised if the selling is over. The next chart that we're going to look at is an hourly candlestick chart of the S&P 500 going back to the 1st of July. The first blue line here is the 3330 level. Now, any of you following my work over the last few weeks know that I was talking about how important that 3330 level was, and you can see here we had, a lot of trading right around that area, down to that area. And the 3330 level was acting as a support level until last Friday when we broke beneath that, and I warned of further downside, and of course that is what we got today. This blue line here is set at 3240, so there's been some trading right around that 3240 level going back to July, but guys, there's just not a lot of support here. So is it possible that that 3230, 3240 level will hold up for a few days? Yeah, it's possible, but there's just so little trading right at that level that I would be surprised if that holds as our long-term support level. The next area of support is going to be found at 3200, and you can see that there was a lot of trading in the month of July between 3200 and 3240. So in the short term, I think 3200 is really going to be a better support level for us than this 3240. The next chart that we're going to look at is a 3-year daily candlestick chart of the S&P 500. And I want to apologize because these candles are all squished up because it's a 3-year daily, so it's really hard to see the individual candles. But I wanted to use the daily prices so you guys could really get an idea of the true support and resistance levels below where we're trading. So when we pull back and look at this 3-year chart, which does extend, of course, now back to 2017, we can see here's today's candle right here, okay? And if you look at the 3200 level, yeah, there's a little bit of trading here, of course, in the month of July, and we traded around that area just for a few days in June, but just not a lot of trading at that 3200 level much beyond the last few months. So I really don't think that 3200 is even the answer here. There might be a little support at 3100. I don't have it annotated on this chart, but the 200-day moving average is sitting right around that 3100 level. So it's possible that if we break below 3200, 3100 might hold. But realistically, guys, and you can really see this with your own eyes, if we go back and look at where the bulk of the trading has been below where we're currently trading, it really starts at 3,000 and below. So if we go to the left here, we can see that back in 2019 for the month of July, and then again in September, we had a lot of trading right up to that 3,000 level. And then, of course, we traded down to that level several times and bounced off of that during this summer. So 3,000 really starts the area of support, and then if we notch down just 50 points to 2950, we can see going clear back to the latter part of 2018. We had trading in September and the early part of October right up to 2950. So the 2950 to 3,000 level really is the solid area of support beneath where we are currently trading. Now, if that doesn't hold, then we would probably drop down to somewhere between 2,800 and 2,850. And again, if we look to the left, going clear back to the first part of 2018, we can see that there's been quite a bit of trading between 2,800 and 2,850 on the S&P 500 over the last 2.5 to 3 years. So the bottom line is, yeah, some support at 3,200, but guys, there's just not a lot there. So realistically, we're probably, if the market continues to sell off here, and it sure looks to me like it wants to, then we will probably fall to the 3,000 level or slightly below. And if that doesn't hold, then 2,800 to 2,850 would be the next downside target. And guys, just so you understand, when the market sells off like this, it doesn't matter what you're invested in, okay? Pretty much everything goes down. Now, this is just today's price action, but look at this real quick. The S&P 500 was down. The Dow was down. The small caps were down almost 3.5%. Mid caps down almost 2.5%. The triple Qs at the last part of the day were able to claw their way up and turn positive 24 basis points. But for the bulk of the day, the triple Qs had been negative. The equal-weighted S&P 500 ETF RSP was down 2.5% today. And then, of course, the SPY down 1.16. Now, I want to point out that the difference between the S&P 500 and the SPY, of course, we know that the SPY is about 1/10 the value of the S&P 500, and we can't invest directly in the S&P 500. So this is where you would get your investment. But the difference of 5 basis points, guys, that's just tracking error, okay? But the bottom line is, it doesn't matter what capitalization that you're in when you get days like this, everything goes down. And the same thing goes for sectors, all right? People will ask me questions about sector rotation. But again, when you get these types of days, there's generally no safe place to hide. With that said, late this afternoon, the technology sector, just like the triple Qs, were able to claw their way to a positive return of 86 basis points. But you can see that the other 10 sectors of the S&P 500 were negative today. And again, guys, this is just today's trading, okay? So you can see that when we get these types of days, everything sells off. Now, I can just hear a lot of people saying, well, yeah, but I'm in alternatives. I've got international or gold or silver. Well, let's take a look at that. We can see that the EEM, the EFA, the FXI, all down today, all right? Now, some of them not down as much as other things, but still negative. You know, the gold miners and the gold miner junior ETFs, both down quite a bit today. Gold itself down over 2%, the GLD, and then the SLV for silver down over 7.5%. So again, guys, when you get de-risking in the markets like this, it doesn't matter what you're in, you're probably going to lose money. And now I can hear people say, well, yeah, but I'm in bonds. Well, let's take a look at that. And let's refresh this to look at what worked today. If we look at the TLT, which is the long dated, the 20-year maturity ETF, high quality ETF, right? Government bonds, it was up 50 basis points. So yeah, that helps. But guys, the yields on high quality bonds are so low these days that if you're in a 60-40 or 70-30 portfolio, they're only going to help you so much. And when you're down, when you're down over 1% on the S&P 500, yeah, okay, it's going to help a little bit if you're up 50 bips on the TLT or up 18 basis points on the IEF. But realistically, it's just not going to, there's no way that high quality bonds can protect an equity portfolio, the long equity part of a portfolio, like they could have a dozen years ago when the yields were substantially higher. Okay, so just keep that in mind. And also, guys, if you're in low quality bonds like junk bonds were down today, as we can see by the JNK and the HYG, and even the corporate bond fund, the LQD, was down 10 basis points. So my point is that you need to be in the right area. If you're going to be in bonds, you have to be in high quality bonds, but to offset equity risk. But even at that, if you're just not going to get a whole lot of protection by putting 30, 40, 50% of your portfolio in these types of investments, it's going to be very hard to make money going forward. So what I'm getting at here is the game has changed, guys, and I'm just trying to help you, so stay with me here, okay? This is super important. But this is why I spent over 20 years for my own benefit creating the Simple Market Signals model. And it's never been more important than now to have a risk management system to work with. A risk management system that helps you understand the level of risk and the trend direction in the stock market so that if you desire, you can move your equity exposure up and down to match the risk levels in the stock market. Because again, with bond yields being so low these days, guys, that it's just the only way you're really going to, in my opinion, the only way you're really going to win going forward is to adjust your equity exposure up and down. And if you guys are financial advisors and you're watching this, you know exactly what I'm talking about here, okay? And this can really help your clients, you and your clients out. And that's why I have so many financial advisors that subscribe to Simple Market Signals, because they get it and they're able to use the signals to help change the risk levels of their client's portfolio to match the risk level in the stock market. Now, let's take a look here. And this is just a brief example of what I'm talking about. Now, this is a 1 month chart where each candlestick represents 1 day of trading. Okay, so this is just really zooming in on the last month of trading. But I want you to know that on 9/3, September 3rd, okay, I sent out an intraday email to my subscribers warning them of changes in the stock market. Now, it might be easy to see this looking back and say, oh yeah, big old candle, okay. But guys, this was intraday I did this, all right? Based on the model, I could see some things changing, and I warned my subscribers that this could be the beginning of a sell-off. On 9/3, I also let my subscribers know that any further downside would probably trigger a change on the readings within the proprietary model. And sure enough, the next day, we sold off further, and that did trigger some changes to my proprietary model readings. And again, intraday on 9/4, I let my subscribers know that there had been a change to the proprietary model. And you can see how the market has sold off further from this point. So with that said, let me tee up a little bit more information for you. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green. And the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how simple market signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend. And I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the simple market signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this simple market signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal. We had the general trend indicator went negative. And then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the simple market signals model, there are three powerful indicators. There's the simple market signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signal subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file, all right? So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend, all right? So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders because it's probably hidden in there. All right, so you should get the automatic welcome letter, and then the latest edition within the next day or two of your subscription, and then again the standard newsletter goes out every weekend. But we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.